Joining me now to provide insight on the day's market performance is Kyle Burgess from Nedbank Private Wealth. Kyle, thanks so much for your time this afternoon. So, more news out from Trump as usual this time around. I guess good news. He is backtracking on those comments he made on Trump, which did initially spur concerns around the independence of the central bank. He has said now that he has no intention on firing Trump. He then also said that he's looking at cutting back on tariffs on China. This, of course, good for sentiment, right?
Yeah, certainly, Tarling, and how's it going? It's thanks for having me on the show. I think if you just perhaps cast your mind back to before the Easter weekend, which really was only a couple of days ago, I mean, you had essentially Trump going after the chairman of the Fed, which is supposed to be an independent institution, which I think rightly had markets quite rattled. And again, you know, we also had significant tariffs on China, which really threatened global trade. And it's really been in the last 2 or 3 days that we've seen that backtracking, articles coming out around Trump not firing Jerome Powell, which I think is certainly positive. But again, you know, there's this underlying volatility and underlying risk that still exists in markets. So while it's a bit of a relief, you know, it could be interesting to see where we are at the end of this week or even at the beginning of next week, whether that changes policy perhaps in the White House or at the Fed, we'll see.
I mean, even as soon as this afternoon, Kyle, at a snap of a finger, one announcement from Trump can really change everything. Let's go back to the relief we are seeing. We are seeing some good news on the local front as well. Inflation easing to 2.7% in March, really on the outside of the SARB's 3 to 6% target range. Yes, we have global market uncertainty spurring global slowdown fears, but surely, Kyle, surely this leaves room for the SARB to consider cutting rates at its next meeting?
Yeah, you'd certainly think so. I mean, as you mentioned, we're outside of that 3 to 6% bracket that that the central bank has operated in for a while now. But again, you know, we've been in a position where the SARB, I think, has managed price inflation in South Africa exceptionally well, and it's really trying to manage, you know, really significant moves in commodity prices that may impact consumers. So I think that, you know, certainly given themselves some room to perhaps cut rates going forward. But again, I mean, you know, if you just go back to the inflation numbers, we are seeing some nice relief in terms of education and from fuel costs, which I think played a big role in inflation coming down. So certainly a lot of relief for consumers as well. So I'd imagine banks and retailers would be, you know, reacting quite positively to that news.
And we saw the financial 15 being the biggest gainer on the JSE to that today. And that, of course, also on the back of Capitec's numbers. I think the last time I checked, that share price was up over 9%. Bumper numbers coming through from the counter. Headline earnings up around 30% as it continued to onboard more customers. That personal banking unit really showing no signs of slowing, Kyle. And what I also find interesting is that we are seeing Capitec also attract middle to high income earners. What stood out for you from those numbers?
Yeah, I'm telling, as you mentioned, a really strong set of numbers. I mean, if you have a look at HEPS, they were up around 30% year on year, which is really significant. I mean, if you look at that in comparison to the rest of the banks in SA, certainly beating them by a country mile. But I think, you know, if you are a banking business that's competing with Capitec, you know, that business has you know, printed ROE numbers again, which are very impressive, coming in at 29%. It's really only First Rand that are competing with them on that front. But what stood out for me was really not only the revenue growth and the earnings growth that they've been able to achieve, but in terms of they've been able to manage their costs quite well. And then the amount of sort of levers that they have to pull going forward. You know, it's all good and well to report a good set of numbers for the last 12 months, but it's about maintaining growth of that 30% growth going forward over the next 2 or 3 years. And you know, certainly if you can start operating in the credit market, which you know they have been now for 12 or 18 months, you know, it certainly makes your client base quite a lot more stickier. There's more products, and there certainly is a large demand for credit in SA, whether that's home loans, or personal lines of credit. So again, just making your customer base very sticky. So for a business that continues to attract, high numbers of customers, high numbers of transactions each month, certainly looks positive. But again, from a valuation perspective, Capitec almost needs to continue growing at these really strong growth rates just to justify where they're currently trading. But it's a business that we like. We own in client portfolios, and it's performed really well for us. So pleasing set of numbers.
Now, not so good news. Afrimat warning of a profit hit of up to 90%. It's pointed to downbeat showing from various units, including, its cement unit, dynamics playing out in the iron ore market. What did you make of that trading update, Kyle?
Yeah, so Afrimat's a business that we haven't really kept a close eye on in the last, I'd probably say 2 or 3 years. So I'll probably only be able to provide you quite sort of low resolution comments on that, which I don't think would be very helpful.
Before we get into the stock picks clip, a counter that I found interesting today was Aspen. That share price was down almost close to 30% this morning. This, of course, on the back of it flagging that there'll be a 2 billion rand hit to earnings in its manufacturing business over a dispute. Now, the company held a presser this morning as well, and the company really just repeating what it had said in its SENS statement. Even in the Q&A session, it seemed like CEO Stephen Sod couldn't provide any detail into that dispute as well. Do you think that's what really spurred the sell-off on that counter?
Yeah, so I think the news broke last night that there's a contract dispute in one of their processing or manufacturing businesses based in France. And if you look at their manufacturing or the breakdown of the business, manufacturing represents about 35% of revenue. But importantly, they've had really strong growth. I think in the last set of numbers, they were up 25% in terms of their revenue growth.
Yeah.
So really a growth engine for the business. And there's been a contract dispute there, which has led to potentially the loss of a customer. So that's really the only news that's out on it. But I think what's important for investors is that, you all of a sudden left with a 2 billion rand hole in your EBITDA. So, your numbers need to adjust for that. And, we are seeing that reflected in the share price. But I think importantly, and you mentioned the presser that they held this morning, Stephen Sard was sort of at pains to mention that, they still have the manufacturing capability, they still have the IP. So it's about, being able to fill that gap, find a new customer. He didn't really want to sort of commit to any timelines around when they would, or how long it would take to get a new customer online. But again, if you can fill that void, obviously you'd want to fill it quicker than sooner rather than later. But again, I think importantly that this came as quite a surprise to management. And there's very, very slim details on it, while they go through this disputes process. But again, it's quite hard to hide from a 2 billion rand hole in your EBITDA. And as more information comes out about that facility, the investments that they've made in those GLP-1s, it's an area that they've really tried to focus on. It's a fast-growing segment of the pharma industry. So hopefully they'll be able to find a customer to take up that demand. As I mentioned, the manufacturing capability is still there. It's just it relates to a contract dispute. So it'll be interesting to see once those details come out.
All right, let's hit pause on the conversation. Before we get to your stock pick, let's reflect on some counters that have found favor with your industry peers.
I'm going with the Agnico Eagle Mines. It's a gold miner based in predominantly Canada and US. And there are 2 reasons why I think it is probably an attractive option at this time. I think the vulnerability of the US dollar against what we are seeing in the US, potentially if Jerome Powell is fired, we will probably see gold price climbing even further. And then in terms of the cost of production, they are around the 1,300 all-in sustaining cost. So I'll probably think that they would be a safer play against a backdrop of mines being confiscated in the northern part of Africa. But Goldfields has just reported on some of that. But you do need gold, and I would take that safe gold in this manner.
I'm also going for a minor, but a local one in Sibanye. I think there's a few positive things going for Sibanye. Obviously, relatively constructive on the PGM sector, given the kind of trailing performance in the past couple of years. And also remember, Sibanye has also got gold exposure, which was a smaller business in the past couple of years, but now with gold at almost 3,500 rand, it's becoming a meaningful contributor. They've done a few cash flow deals, streaming deals, so of course streaming deals to kind of help bring cash flow forward to help shore up the balance sheet as well. So I think those concerns are being allayed from investors. So it's a good option, I think, at this point to look at some money.
So analysts are betting on the mining sector. We have Sibanye as well as Agnico Eagle Mines. Just your analysis around those counters.
Yeah, thanks, Tarlings. The commodities certainly seem to be in focus at the moment. So Agnico is not a business I've followed very closely at all, so I wouldn't be able to comment on that. But Sibanye is still water. I mean, if you have a look at the share price, that's down, over the last 5 years, around 30%. That's against the backdrop of, the all share being up about 80%. So significant underperformance there and, somewhat shareholder destructive moves from that share price. I can understand the rationale, perhaps from a valuation perspective. You're trying to get exposure to gold, where gold's trading at $3,400 a fine ounce. At record highs, you're getting some nice exposure to PGMs. You're getting some geographical exposure in terms of their operations. They've got quite a nice tailings business in Queensland, in Australia. So, I can understand the rationale behind it. It's a business that we've avoided certainly for a long period of time, even when they were performing exceptionally well during the late or early 2020s. But yeah, I can understand the rationale behind it, but it's not necessarily a business that we have invested in or are currently investing in.
So talk to me about what you're not avoiding. What are you hanging your hat on today? Your stock pick, Kyle?
Yeah, thanks, darling. So it's a bit of a different one. We usually sort of give our views on specific businesses, but I think if you have a look at the global environment and even to an extent the local environment, volatility is the name of the game at the moment. So you'd want broad-based exposure across multiple different markets. For us, this is in the form of our actively managed certificate, or AMC, our Nedbank Private Wealth global portfolio. So in the past, the view's really been that, we've been able to pick up really nice offshore exposure for clients through tracker funds, whether that's the S&P 500 or the NASDAQ, or even a global equity fund, which would hold, significant exposure to the US. But, as valuations, particularly of tech counters, have ramped up in the last few years, we found that, you probably need to have a bit more finesse in terms of what you're buying for clients, certainly in the offshore space. So we've leveraged our research capabilities locally, applied that to the international market, and put together a fund where, we're largely sitting in US dollar cash at the moment. And the idea was, this was launched sort of towards the end of last year in September, to take advantage of opportunities that may come from a re-rating in US markets. Of course, we didn't foresee, significant volatility as a result of what's happened from the White House or President Trump. But that, I suppose when markets are trading at such significant valuations, that's always likely to happen. Something generally always happens. So, we're sitting in a position in the fund where we've got significant US dollar cash exposure, where we are able to take advantage of businesses that have sold off over the last 2 or 3 months. We're not necessarily avoiding US tech at all. In fact, we hold businesses like Amazon in it currently, and we've been able to pick up great businesses like LVMH, which has been a stock that I've spoken about on the show before. So that's been a recent acquisition to the fund. So again, it's been able to give clients exposure to great businesses across developed markets, but not really pay 23, 24 times earnings, and then again being able to cherry pick that exposure that you want for clients, and really be disciplined on the prices and valuations that you getting these businesses at. So a bit of a different stock pick, but again, I think it's, the environment that we're in at the moment, you want to be very diversified, and you ultimately want to have exposure to some of the greatest businesses in the world over a long period of time. But, I think key to that is paying the right price for it. And, that's what we're trying to do in our fund at the moment.
All right, Kyle, thanks so much for your time and just sharing your insights this afternoon. That was Kyle Burgess from Nedbank Private Wealth.